Imagine you're at the party and suddenly someone turns down the music. What happens? People start talking louder, right? Well, believe it or not, the stock market works in a surprisingly similar way. When the Federal Reserve lowers interest rates, it's like turning down the volume on the cost of money. But what really happens to stocks when this financial music gets quieter? The answer might shock you or surprise you at least. So today we are diving deep into the world of Federal Reserve interest rates and their impact on the stock market. We will uncover why rate cuts can send stocks soaring, explore the hidden risks, and reveal what smart investors do when rates start dropping. So let's rewind a bit. The Federal Reserve, or Fed, has been manipulating interest rates since 1913, but it wasn't until 1980s that we really started to see how powerful this tool could be. Remember Black Monday in 1987? The Fed swooped in with the rate cuts and the market eventually recovered. Fast forward to 2008 and we saw rates slash to near zero. The result? One of the longest bull markets in history. Now let's break down what happens when the Fed cuts rates. First, it's like injecting adrenaline into the stock market. Borrowing becomes cheaper for companies, which can lead to increased investments and potentially higher profits. This often translates to rising stock prices as investors anticipate improved company performance. At the same time, bonds become less attractive to investors. When interest rates fall, the yields on new bonds decrease, making existing bonds with higher rates more valuable. However, for new investors, the lower yields make bonds less appealing compared to the potential returns of stocks. This shift can drive more money into the stock market, further boosting prices. Consumer spending often increases as well. Lower interest rates mean cheaper mortgages, car loans, the credit card rates. This extra cash in consumers' pockets can lead to increased spending, which in turn can boost company revenues. And you guessed it, stock prices for sure. But here's where it gets interesting. Not all stocks are created equal when rates drop. It's like a game of musical chairs, but some chairs are more comfortable than others. Financial stocks, for example, often take a hit. Banks make less money on loans when interest rates are low, which can hurt their profitability and stock prices. On the flip side, real estate and utility stocks tend to surge. These sectors love cheap borrowing because they are typically capital-intensive industries. Lower rates mean they can finance new projects more affordably, potentially leading to higher profits down the line. Tech stocks can be wild cards in this scenario. Their reaction often depends on their debt levels and cash positions. Cash-rich tech companies might not see much benefit from lower rates, while those with high debt loads could get a significant boost. Now, here's the part that might keep you up at night. Rate cuts aren't always good news. In fact, they can signal a weakening economy. The Fed typically lowers rates when they are concerned about economic growth, inflation or unemployment. So while stocks might initially jump on the news, savvy investors are also looking at why the Fed felt the need to cut rates in the first place. Moreover, too many cuts can lead to inflation. It's like adding too much sugar to your coffee. A little might taste good, but too much can ruin the whole cup. When money becomes too cheap for too long, it can lead to excessive spending and investment, driving up prices across the economy. There is also the risk of creating asset bubbles. Remember the dot-com boom? Low interest rates were one factor that fueled that frenzy. When money is cheap, investors might take on more risk than they should, bidding up asset prices to unsustainable levels. Looking beyond the initial stock surge, sustained low rates can have some strange effects on the market. They can lead to the creation of zombie companies, firms that shouldn't have gone bankrupt, but continue to operate thanks to cheap debt. And this can distort true market valuation and potentially set the stage for a painful correction down the road. And let's not forget about the eventual rate hikes. What goes down must come up. And when the Fed starts raising rates again, it can cause significant market turbulence. Stocks that benefited the most from low rates might suddenly find themselves on shaky ground. As legendary investor Warren Buffett once said, "Only when the tide goes out do you discover who's been swimming naked." Low rates can hide a lot of problems, but they don't solve them forever. And in my view, Fed rate cuts are like financial painkillers. They can make us feel good in the short term, but they don't cure the underlying economic illness. Smart investors look beyond the immediate stock surge and prepare for the long-term consequences. So what should you do when rates start dropping? First, don't blindly jump into stocks. Do your research and understand how different sectors and companies might be affected. Consider rebalancing your portfolio to include rate-sensitive sectors that might benefit from the new environment. It's also wise to keep some powder dry. Market overreactions are common, and having cash on hand can allow you to take advantage of buying opportunities if stocks take an unexpected dip. And now you might be wondering, shouldn't I just buy stocks every time rates drop? Not so fast. Remember, the market often prices in expected rate cuts before they happen. By the time the Fed acts, it might be too late to catch the biggest gains. Moreover, as we've discussed, rate cuts can sometimes lead to market declines if investors are worried about the economic outlook. Next time you hear about Fed rate cuts, remember, it's not just about stocks going up and up and up. It's about understanding the complex dance between monetary policy and market psychology also, like a chess. Like that party with the quieter music, sometimes the real actions happens when things seem to calm down. In conclusion, navigating the stock market during periods of changing interest rates requires a nuanced approach. It's not just about following a simple rate down, stocks up rule. Instead, successful investors consider the broader economic context, understand sector-specific impacts, and remain prepared for both opportunities and risks. If you found this breakdown helpful, smash that like button and subscribe for more insights into the wild world of finance. And hey, let me know in the comments, what do you think the Fed should do with rates right now? Are we headed for more cuts, or is it time to start raising rates again pretty soon? And my dream is to make my own hedge fund one day, and I keep learning from best investors and invite you to do it with me. You can see my results as a portfolio manager who is beating index S&P 500 here. Remember, I am not a financial advisor, just a curious explorer of the markets. Always do your own research before making investment decisions, guys. And see you in the next videos, I hope.